Hi, welcome to Module 4, Raising Funds and Financing a Mining Project. In this module, we're going to be looking at where do we go to finance our mining project from early stage prospecting and exploration all the way through defining our resource or our ore body to pre-development, bankable feasibilities, and moving into actual building of the mine and production. So the graphic that we have on the screen at the moment will give us an indication of the types of financiers that get involved at various stages over the life cycle of a mine. So on the left-hand side of the graph, we have where we have the discovery, and on the far right-hand side is when we will move into on production and ongoing operations. And what we'll see is that until we've got to the stage where we've done a bankable feasibility, and perhaps a little bit earlier stage than that, a pre-feasibility, that's classified as junior miners. And after we've done a bankable feasibility and we're moving into the development of a mine, we start moving towards the majors. Okay? So if we have a look at the types of people that get involved in the types of funding partners that will get involved in early stage discovery, exploration and so on, it's your private equity funds, hedge funds, private individuals, that kind of thing. Okay? As we move along the value curve then, and value is building and risk is diminishing, we'll find that the private equity people carry on. They might take an exit at that point, but they will continue. Your hedge funds will continue, but now you'll be able to attract in public funds also. So we're broadening the base of the type of investors that come in. Once we've done our pre-feasibility or bankable feasibility, that's when you'll see that your institutional investors, your banks, and your general public will come in a big way. So that's where you'll attract bigger amounts of public capital and debt and so on. Why wouldn't we really find the banks getting involved at early stage discovery or exploration? Well, we don't want to see on a junior's balance sheet that isn't producing income too much interest-bearing debt, because what that means will be that you have to raise money from the public in order to service interest, and that's not a good idea. You'd rather see all the money that you have going into the ground and developing the project. What I'm doing here is from the introduction module where we looked at Mining 101 and so on, and we first had a look at resources and reserves. I'm just recapping. So remember that the resources are split into 3 categories: inferred, indicated and measured, and our reserves are split into probable and proved, as on the screen there, the definitions. And then here we're having a look at, again, our reserves and resources framework. Important to keep in mind, because it tracks the life cycle it very closely tracks the life cycle of the mine itself. So we move from reserves into, we move from resources into reserves. Okay? And what I'm giving you now on screen is an example of how a mining company reports its resources and reserves. So here, this example is Banro Corporation again. And you'll see that they have 3 categories of resources and the 2 categories of reserves. So we have our measured, indicated, and inferred, and a total of that category being mineral resources of 4.5 million ounces. And then below that, in a separate category altogether, they show the proven and probable, or what we often call 2P reserves, and that's 4.5 million ounces. What I have on screen at the moment is a very interesting graphic, and this plots the share price and value of the firm, market cap, over the life cycle of the mining venture. So what you'll see when early stage discovery is made is that the value per share increases radically. And then when reality sets in, you'll see a drop-off in the share price, And the hard work of actually going through the feasibility studies and so on, and developing the mine plan and that kind of thing takes place. And only once you get into pre-development and development of the mine itself does the share price start recovering as the mine goes into operation. And then you'll have your sustainable growth as the mine competes head on head with its peers.